Welcome back. Market news now. In Tokyo led a rout of Asian shares on Thursday morning. Trading mirrored big losses, which did mirror big losses out on Wall Street after the Fed defied unprecedented pressure from Donald Trump and raised interest rates, sparking fears that that move could indeed choke economic growth out in the world number one economy. The Nikkei plunged to a 15-month low as investors took fright over the pace of monetary tightening, with a slump triggered by the Dow's fall to its lowest level of 2018, beginning then to gather pace. So down the market went, with Tokyo slipping almost 3% at close. Hong Kong's Hang Seng also slipping 1.3%. The Shanghai Composite was 0.5% down at close as well. Let's shift things over now to the United States, where stocks declined sharply on Wednesday after the Federal Reserve's forecast of fewer interest rate increases in 2019 that fell short of investors' hopes of a more dovish monetary policy. The Dow Jones Industrial fell 1.5% there, 23,323 points. The S&P 500 lost 1.4% to close trading at 2,510. And the Nasdaq Composite dropped over 2% to end the day at 6,643 points. That Fed decision to raise interest rates, as I've said, will be the key and most pertinent issue to discuss today. Jerome Powell perhaps defying the president. Of course, it is an independent body when it comes to the U.S. Fed, but would the Fed have raised interest rates had it not been from pressure from Donald Trump not to do so? A lot of questions will continue to be asked, but the globe is down, headed lower across the board as the Fed had just hiked interest rates by that 25 basis points. Here's an exact look at the numbers. Over 0.5% down for the JSE today, and any thoughts of an uptick as we head even closer to Christmas? Certainly not on the cards today. So we unpack the market movement. We continue to get into exactly what has happened. Jerome Powell, essentially the governor, the chair of the Federal Reserve out in the United States, having decided to increase interest rates. We'll discuss that and a whole lot more. Makwe Masilela from Makwe Fund Managers joining us in studio. Thank you so much for the time, Makwe. So the Fed decides it's going to raise interest rates. The prospect was getting less and less as we headed to the meeting, but it wasn't really a surprise move, and that's not the important part, right? It's the moves for 2019 that shocked the market.
By all means, and I think the rapidness of increasing interest rates will always determine what happens to the equity markets. Because I think we need to bear in mind, why interest rates went down in the first instance. It was because of the financial meltdown, and now the reason they took interest rates down was to try to help the economy, and there was cheap money. So we got used to cheap money for a very long time. Yeah. Just they say they just increased interest rates 4 times. So now we thought maybe things won't continue the way they are continuing, but everyone is concerned about the slowing global economy. So now if you continue to increase and the global economy is not doing okay, then it's not going to work out, let alone the trade issues. But I think another thing that markets are not maybe reading into it, this whole thing of quantitative easing, I think we're getting more into quantitative tightening in the sense that they've got a balance sheet that they need to deal with. Yeah. So now if that saying is just on autopilot, the markets are starting to worry. They thought maybe they'll also adjust that part as well, but seemingly the chairperson doesn't going to be doing that anytime soon. It will just continue the way it's continuing.
Does this hamper growth out in the United States then?
By all means, because companies, you need to raise money to be able to expand. So if money becomes expensive, then now chances are you won't be able to raise that money, or you won't be able to get the right benefits. So those are one of the things. But the markets have just been spoiled for a very long time with this cheap money that we've been having access to. Yes, so far, you could still get it from the likes of Japan because they left interest rates where they are. Today, ECB is also this afternoon. I mean, not ECB, the Bank of England, they are having their meeting. Chances are they'll leave interest rates where they are. But yes, this whole thing of being able to get cheap money from the US and you go and buy or invest it in other countries where you get better yield, that's how we've been making money so far.
The Reserve Bank Governor of South Africa, Lesotho Kganyago, did say when he hiked interest rates in November by 25 basis points that global normalization of interest rates, so essentially the Fed hiking interest rates, is also a worry for them. Do you think because the gap widens again now, that it puts pressure on him as well to act in January?
Not really, given what's happening with the rand, also given what is happening with oil prices, because his job is just to make sure that inflation is between 3 and 6%. Inflation targeting. What has been driving on inflation so far? It has been high oil prices, but oil prices we're talking today is almost $55 a barrel.
Yeah.
The rand as we're talking today is almost strengthened, almost 1%. So I don't have any reason to increase interest rates when they meet in January.
Yeah.
Anyway, markets were not too happy with that move in their last meeting in November.
Should we be fearful of where the United States is then? Donald Trump believes that the economy is doing well. Clearly, there are some fears of even a recession in the world #1 economy. Jerome Powell decides to hike interest rates at the defiance of President Donald Trump. And yes, fine, Jerome Powell doesn't listen to the presidency, but surely that must have sent some sort of message clearly back and forth there. And clearly they're trying to say, we're going to do things our way here.
By all means, that's supposed to be independent. Credibility is all important when it comes to the central bank. But I think they're going to be more data dependent going forward. If inflation, in the US gets to show that it's running away, definitely they have to act. I think what they call the dot plots, that's showing almost 3 interest rates next year. But people are also talking about 2. But markets, if you check the bonds, what's happening? I mean, the US bond yield curve, people consider that as a way of showing you whether recession is coming or not. And so far, we've seen that it has inverted. So people are thinking that there might be a recession going forward. But the long and short, this whole thing has to be data determined. You don't have to have that or try to be clever to try to second guess them.
Yeah, 14 Rand 22 against the US dollar. The Rand is perhaps one would say still muted, really. Still above 14 Rand. It's not that impressive, really, right? Considering that we saw it at 13.50. Is this sort of where we end for the year?
Probably, and yes, 1% is quite a lot. But if you put it in the whole perspective, this time last year, the rand was almost 12.70.
Yeah.
So 14.20 is understandable that we are not too impressed. We need the rand to be a little more stronger, at least anything below 13.50. Will we be able to see that before Christmas? I doubt.
Yeah, considering that there isn't much by the way of data left as well for the remainder of this year. Let's talk about yesterday then. Christine Lagarde flies into South Africa to much fanfare, meets the president, meets the Reserve Bank governor. The #1 question, does South Africa need any help? Have we asked her for any help? The answer from her is no. She then gives a very good message on how South Africa looks and even says we don't need the help. We're still fine. Balance of payment issues, we're fine. We don't need all of that. But do you think we should actually be excited and as happy as that message suggests?
Up until Christmas, we should be excited. Let us not spoil our festive. But the biggest thing, we've got this debt to GDP, which is sitting at almost 53.
Yeah.
Now we've got issues with state-owned enterprises. We've got issues with the government itself not being able to meet their revenue targets because of what happened at SARS. So at some point, the government had to start borrowing more. So if you increase your debt to almost anything more than 60, then unfortunately, you don't have much of a choice. We've just seen that indirectly, the PIC, or whether you call it the government, bailed out the Dinel because they bought almost 90% of their bonds within a year. So that shows you that things are not looking okay. But I think the biggest thing will make sure that you get a decent growth, and decent growth is anything more than 3%, to make sure that your debt to GDP ratio doesn't get to the likes of 60, 65, because or else you don't have much of a choice but to go and borrow money. And at the same time, given your investment grade, the minute you go out and borrow money, they charge you high interest rates because you're not an investment grade. It's only Moody's who's holding you at just above investment.
Yeah, she did mention quite a bit that she is indeed worried about South Africa's credit rating, but that she does get reassurances from the president that things will be sorted out, including the land issue as well. Makwe, we do appreciate your time. Have a wonderful festive season. Hopefully I'll see you early next year as well, and continue to unpack the mire that is this market picture. Of course, Makwe Masilela is from Makwe Fund Managers. They're unpacking that market movement as we close out